Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Hello everyone, welcome back to our weekly podcast Through the Noise. My name is Hannah, Portfolio Strategist with the CIO office here at Standard Chartered, and I will be your host for today. So joining me today is Fook Hien, our Senior Investment Strategist, to help unpack market events and talk about positioning and where other opportunities might lie next. So hi Fook Hien, thank you again for joining us today. So maybe perhaps something that we've seen so far, is clearly the underperformance of US equities compared to their global peers. So US equities is only up about 0.2% year to date, while we've seen, Europe about 5.5, Japan in dollar terms is also at about 14%. So what's really driving this underperformance and, any chance of a catch up in the US equities?
Yeah, thanks. Hi, Hannah. So US equity benchmarks, they are little change this year, significantly lagging their global peers, as you say. Japan and emerging markets, including our preferred Asia ex-Japan, are extending their outperformance from last year. And Europe is not far behind. The US underperformance has been driven by an investor rotation from certain technology sector segments, such as software services, which is seen as most negatively impacted by AI developments, and investors are rotating into the more cyclical sectors such as industrial, material, and energy sectors. The US equity market being more heavily weighted towards your tech-related sectors compared with markets in Europe, Japan, or emerging markets has underperformed as a result. Nevertheless, US technology segments, they are benefiting from the AI revolution, such as semiconductors and AI infrastructure providers. These have delivered strong returns. The last factor also explains why South Korea and Taiwan, the two semiconductor leaders, are the best performing major equity markets this year. While the US equity market lags, the economy continues to deliver positive economic surprises, more so than Europe and Asia. This week's data showed a stronger than expected industrial production and core capital goods orders, along with a pickup in housing starts and building permits. And this followed stronger than expected job creation in January. Meanwhile, the US corporate earnings growth outlook, it remains stronger than other major equity markets, except for Asia ex-Japan. In fact, the US 2026 earnings estimates have been upgraded in recent weeks following strong corporate guidance. Now, alongside the broadening growth, US disinflation continued in January, with the headline inflation falling sharply to 2.4% year-on-year from 2.7% year-on-year in December. We believe that continued disinflation is likely to enable nominated Fed Chair Walsh to convince fellow policymakers to cut rates by 75 basis points by the end of this year after he takes charge in May. So in summary, we expect a broadening economic activity in the US, continued disinflation, and further Fed rate cuts to lift US corporate earnings outlook, and this would enable US equities to catch up with the global peers this year.
All right, so I think we've talked about how US equity seems to be lagging other regional equities like Europe and Japan. You've painted quite a good picture on that. But what's the team's outlook, and how should investors continue to position themselves then?
Yeah, so we see US equities being able to catch up with global peers this year. 2026 US earnings projection remain robust, led by the technology sector. And we are overweight technology, but within that, we prefer exposure to semiconductors and internet companies currently in this technology cycle. Furthermore, we prefer to diversify into other US sectors such as healthcare and utilities. We believe that US healthcare offers defensive earnings growth driven by innovative medicine. Meanwhile, US utilities also offer defensive earnings growth boosted by higher electricity demand amid the rapid data center build-out. So diversification and a focus on quality remains key amid the widening dispersion among equity markets and sectors. And then outside of the US, we continue to prefer the Asia ex Japan equities.
All right, so maybe let's switch it up from here. Let's maybe move over to currencies. I think recent UK data that has also pointed to a faster than expected labor market cooling. We've also seen consumer inflation falling. So, any expectations on the BOE decisions and what kind of impact we might see on the pound?
Yeah, we expect the Bank of England or BOE to cut rates in March. And then on the bond side, we see a 5 to 7 year bonds as offering an attractive balance. And on the currency side, we expect the pound to US dollar to edge lower to 1.34. So we believe that further policy easing from the Bank of England or BOE is increasingly likely after recent data showed the faster than expected cooling of the labor market. We saw the unemployment rate rose to a near post-pandemic high of 5.2% in January. Private sector wage growth also slowed, suggesting fading inflation pressures in the UK. We saw January's consumer inflation. It fell to 3% year on year, which is the lowest level since March 2021, but services inflation eased only to 4.4%. While a March BOE rate cut is likely, the pace and timing of further easing is less certain given the elevated services inflation. So this, along with political uncertainty ahead of local elections, risk keeping the UK government bond volatility high. As a result, we favor the 5 to 7 year maturity bucket within UK bonds, which we see as offering a balance between attractive yields and exposure to the rate cuts against inflation and fiscal risk. On the currency, the sterling remains caught between a likely lower short-term UK bond yields and a weak US dollar. So on balance, we expect the pound to the US dollar to edge lower towards 1.34 over the next 3 months.
All right, and maybe just a final one on the Swiss franc. Any views on this currency, given the strengthening that we've seen in recent weeks?
Yeah, our view is that we expect the US dollar to Swiss franc to fall to 0.75 and 0.74 over the next 3 and 12 months, respectively. More broadly, the carry trades, which are concentrated only around the Swiss franc, are expected to continue underperforming a more diversified carried strategies. So the Swiss franc, it has strengthened in recent weeks, falling below the key 0.78 level, driven by US dollar weakness, still high Swiss real yields, and safe haven demand for the Swiss franc. While a safe haven demand is likely to fluctuate, we expect further US dollar weakness and the Swiss real rates to remain well supported. Our expectation of 3 more Fed rate cuts this year, combined with a largely unchanged Swiss policy rates, means the US dollar's interest rate advantage will continue to lessen. This will narrow the gap between US and Swiss interest rates and likely to be a key driver of a weaker US dollar and a stronger Swiss franc. Technically, the break below 0.78 does open the room for further downside in the US dollar to the Swiss franc, and any short term rebounds are likely to stall near 0.78, a level that has held several times in recent months. And so, this is suggesting further downside. Any direct intervention by the Swiss National Bank in the FX markets or a move to negative interest rates remain the risk to our view. So the bottom line here is that we do expect diversified carry strategies to outperform concentrated ones.
All right, thank you, Fook Hien. I think there is much for us to think about and digest, but maybe if I could just summarize it into three key takeaways. So we're seeing supportive US fundamentals, continued disinflation, and further Fed rate cuts to be quite supportive of US equities, helping them to catch up with global peers. But as always, diversification and focus on quality remains key, something I believe the team has been highlighting for a while now. Secondly, the team also expects an imminent BOE rate cut with a preference for the 5 to 7 year segment in terms of UK rates, and also favors a pound dollar upside in terms of broader dollar weakness. And just lastly, I think for investors looking at carry trades, again, the diversification theme stays. So diversified carry strategies is the way to go, as it should outperform a concentrated one. So I think that's all we have for today. Thank you again, Fook Hien, and of course, thank you to all our listeners for joining us on today's Through the Noise podcast. Please do like and subscribe if you enjoyed today's conversation, and we do look forward to speaking with you again next week.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details, visit Market Views on the Go on our website or click the link in the description.